In 2019, investor and consultant JOSIAH Tan bought a condominium unit in Kovan for over $1 million Sing dollars. He signed up for a 30-year bank loan with a 2-year fixed interest rate of 2.1%. He paid $3,000 a month for the mortgage and rented out the property. The loan was refinanced last year when interest rates were lower. And this year, he sold off the property to buy an HDB flat where he and his wife will live.
I went from Maybank to OCBC, and the rate went from 2.12 to 1.2%. So it was great. But to me, it was a huge savings right there already. And then when I recently just bought another property, and that was before the recent rate hike, so it was 1.35% thereabout.
Those taking on mortgages now will no longer find such low rates.
If you have $1 million property and interest rates increase from 1.65% to the current 2.25% fixed interest rate, you're probably going to have to look at an additional monthly installment of about $300.
Some homeowners will feel a bigger impact from the rate hikes.
Those people who will maybe refinance the property in 2019, 2020, right, or bought the property about that time as well. And if you're pegged to SIBOR. Now, these clients are the group of clients that would definitely want to review your mortgages as soon as possible.
While it won't be in use as a mortgage peg moving forward, the 1- and 3-month Singapore Interbank Offered Rates, or SIBOR, has been on the uptrend in the past 3 months. The overnight rate benchmark, now mostly used for loans, has also risen significantly since March.
The home loan package normally is SORA plus a premium. For the first 2 to 3 years of the loan packages, the premium averaged about 0.6 to 0.8%. But what homeowners should be looking out for is the premium that the bank will be charging after the 3rd or the 4th year.
Mortgage rates in Singapore, which track the US Fed, are primed to rise further as policymakers signal more hikes to cool record-high inflation.
Fed Chair Powell has quite clearly indicated 50 basis points hike could be coming in again for the next 2 meetings. So we are expecting that in June and July FOMC. Beyond that, we are expecting 25 basis points hikes coming in for the remainder of the year.
Sing Capital says this could translate to Singapore's benchmark rate rising to over 2.5%. Redbrick says clients now face the dilemma of choosing either floating or fixed rates as the gap between them widens.
You can have a fixed interest rate, a 3-year fixed interest rate, for example, at 2.5% today, and you can have a floating interest rate at just above 1%. And everyone would generally gravitate towards a fixed interest rate. But because of this large gap, clients are willing to take certain risks to go for floating interest rates because they get a little bit more interest savings.
In Singapore, new property launches will likely be priced higher as developers factor in rising construction costs. But as accommodation costs increase, higher rents will be attractive to property investors.
Rental has risen by almost basically double-digit, almost 12 to 13% rate of growth in the past 12 months. And I think that with the border reopening and with more foreigners coming here to work, study and live, the rental market is likely to continue to remain very healthy and active.
Even as higher borrowing rates push buyers to become more cost-sensitive, market watchers say Singapore's robust property sector could still offer attractive gains.
The HDB resale prices can still rise by about 6 to 10% for the rest of this year. The private housing prices will still rise, but at a moderately lower rate of about 2% to 5%.
Experts say Singapore's limit on monthly debt obligations and mortgage assessment by banks will help prevent borrowers from being over-leveraged despite rising rates. Still, it may be best for homeowners to diversify their property loan portfolio.
one strategy is actually to split your mortgage into two different loans. That means you have one property, you might be borrowing from the same bank, but you have actually two separate loans. One might be a floating rate and one could be a fixed rate.
You can also consider, in this case, going for floating packages with a shorter lock-in period. So a 1 year lock-in period just means that your exposure is limited to that one year. And after 1 year, you then have the ability to reevaluate your mortgage or to review your mortgage again to determine whether at that point of time, going for a fixed, going for a floating interest rate would be better.
It's always good for homeowners to always review their mortgages to actually compare what are the available packages in the market. Being financial prudent is still the most important things for any homeowners to look at.